Hello students, today we'll learn about the financial derivatives which is in the fourth semester for the MBA students. So before we start financial derivatives, I just give you an explanation, a quick explanation about the overview of basics like what is financial market and what are its classification and all. Okay, so basically financial market classified into three markets like money market, capital market and forex market. Forex market or forex. So again we can classify capital market into two, like one is debt market and another one is, we all know, it is familiar to us, that is stock market or share market. So again we can classify stock market into primary market and secondary market. So money market is basically for short term requirement, like less than 1 year, less than 1 year requirement. Suppose any business or professional who wants money requirement for 1 year or less than 1 year, and he has to pay, he has to repay within 1 year. That is mainly money market. And some instruments of money market is like treasury bill or T-bills, then government securities, commercial paper or CP, commercial papers. So basically in money market, procurement and repayment is done within short time period like less than 1 year. Okay, procurement and repayment will be done within 1 year, not much. Then capital market. So there is debt market and stock market. So in debt market, what are trading here, like bonds, debentures. We all know about debt, what is debt. So here, what are the instruments that are, what is trading here, that is bonds, debentures are trading here. Okay, and in forex market we all know about what is currency, currency trading. Okay, now primary market. So what is primary market? Like in this market, a company issued its share, a company issued its share for the first time. Okay, so he has to issue, the company has to issue an IPO, like initial public offering, for issue the share, and after issuing shares, the company um, will be called as a listed company. Like before issuing an IPO, the company is unlisted company, okay, or non-listed company. Suppose so A is a company, it is unlisted, and it is issuing IPO. Then it became listed company, okay. And in secondary market, what are trading here? Here we can trade derivative markets and spot markets. What is this? Like spot market and derivative market. Spot market is nothing but cash market, okay. Everything is settled by cash, like cash settlement. And there is derivative market, and we'll learn it. So what is derivative? Derivative is a contract between two parties, which derives its value from underlying asset. So underlying asset can be the crude oil, gold, silver, like commodity, and any shares, index, anything. Okay. So derivative, what is this? This is a contract. Okay, and it contract between two parties, or we can call them counterparties, okay. And it derives its value from the underlying asset. It can be share, index, crude oil, gold. Later we'll learn about the commodity derivative and financial derivatives. For now it's okay. Okay, so suppose there are two parties, like uh, A and B, okay, and they make a contract that A will sell to be 100 shares, okay. So A today 25th March 25, this is today. So here time is a very precious factor. Like the contract will be done on present day, okay, and the settlement or the derivative or the shares that A uh, sold to B, and B will receive this money or the shares, anything, on the future date, that the date on which both parties were agreed, okay. So they make a contract today, they make a contract today, but A will sell these shares on suppose 25th June. Okay, and B will give money, like money on that day. Okay, now what happens is A will think they both will be agreed on a price like 100 shares on 1000 rupees. Okay, so they both are agreed. Now A will think 1000 will be increased, and B will think 1000 will be decreased. That's how they hedge the risk. Okay, derivative is basically about to hedge the risk of the market, because in capital market there are volatility. The market price can be increased, can be decreased, anything can be happened in capital market. So derivative is one thing through which the two parties or who are interested in capital market or what, like something like that, they make a contract to hedge the risk. Suppose the price is increased, then A will gain a profit, and suppose the price is decreased, then B will gain a profit. And there was on the future date there is a settlement, like physical settlement, cash settlement. So we'll learn it later. But for now, what is derivative? Derivative is a contract between two parties or two counterparties which derives its value from the underlying asset, that may be shares, crude oil, gold, anything. Okay, and the contract is taking place today, but it will mature on future date. Okay, it can be for 3 months, can be for 6 months, like within 1 year, or maybe more than 1 year. Okay, basically it is derivative is mainly for 3 months, 6 months, or 9 months, like this. Okay, now what are the types of derivative? We know what is derivative. There was a silly mistake, like I told you all that if the price will increase, then A will gain profit. No, actually if the price is decreased, then A will gain profit, and if the price is increased, then B will gain profit. Okay, so please consider me. Okay, so types of derivative. There are four types of derivative: forward, future, option, and swap. Okay, future and option both can be classified into three stock future, index future, currency future. Similar options can be classified into three, like stock options, index, and currency options. Okay. Now, in next class, uh, we'll see what are the difference between both types of derivatives, like what is different between forward and future, or future and option or swap. So stay tuned. If you all like this video, then please do subscribe it, please like it, and comment if you know anything, or if there's a mistake in this video, please let me know. And thank you so much. Please subscribe my channel. Thank you.